Hi there, I'm Matt Ishbia, President and CEO of UWM, and this is 3 points. First point, FHA's MIP reduction. So the mortgage insurance premiums on FHA have gone down. HUD announced this long-awaited change. We've talked about it on 3 points a couple times, that now was the time and they finally have done it. Great news across the board. The change will affect loans endorsed on or after March 20th of this year, so right away, basically. And this can make a big difference. It's lowering the premiums, helping increase the opportunity for homeownership for so many people out there just before the purchase season. So on a $300,000 loan, the 30 basis point reduction is like $900 a year or $75 monthly savings. So that's a big deal. FHA has last cut the premiums not since 2015. So big positive change across the board from FHA. Also, they made a change on VA. HUD made a change on VA where the actual funding fee is going to go down. This is for effective, April 7th, 15 basis points. So not as big of a change, and that's on the upfront funding fee, but still positive changes from the government on both FHA and VA loans. Second point, sunsetting Fannie Mae, Freddie Mac's COVID-related underwriting guidelines. So Fannie and Freddie have finally announced that the remaining temporary COVID-19 related selling policies have expired. So verification of business, mortgage history, variable income changes are all expired. It's been 3 years now, so we finally can move on from the COVID guidelines, all the things that tied to it. So, all different things. Verification of business no longer need to document it as active business within 20 business days of the note date. Now, standard VOB. I'm not going to go through all these mortgage history changes. All positive stuff. Fannie and Freddie guidelines are out there, but just know Fannie and Freddie are making positive changes. They've recognized that the COVID guidelines can be sunset permanently, hopefully, and we can move forward with normal guidelines, underwriting guidelines on all those things, and really across the board with Fannie Mae and Freddie Mac. Third point, interest rates and affordability. So people always think that higher interest rates means less people can buy a home and 30-year fixed rates are so high I can't afford a house. And listen, of course, the higher the rate, the more expensive the mortgage, which means less people can afford it. But it's a small number. So let's go through the data here. The data shows that if you went from 5% interest rate to 8%, so a massive increase, only 10% less people in the market could buy a house. So it's not like everyone can't buy a house anymore. And so understanding the changes and understanding that, so if rates go from 6 to 6.75 or 6 to 7, that's not impacting anything. So realizing that affordability is important. Lower rates do help people buy a house, but it's not pricing people out of the market. It's not taking it so people no longer going to buy houses. People are buying houses. The purchase season is coming. The purchase market is actually hotter than people think out there. And so thinking, rates went up a point, I can't buy houses, people aren't buying houses, that's not real market. That's this negative mindset. The market is strong. The opportunity is there. And even if interest rates go up from 6.5 to 7.5, 7.5 to 8, it doesn't impact the amount of people that can buy houses today and that people are out there shopping today in the market. Thanks for joining me. I'm Matt Ishbia, President and CEO of UWM, and that was 3 points.